Welcome to the Deep Dive. Today we're embarking on a mission, really, to uncover the financial pulse of Apple Inc.
A giant, really?
Absolutely. We've taken a whole decade of their 10K reports, those SEC filings, from 2014 right up to 2023. And we're here to boil down the most, surprising bits and insights for you.
That's right. We'll get into how Apple didn't just get bigger, but how they kind of strategically reshaped their business and managed their finances in some really sophisticated ways. Even with all the global economic stuff going on, you'll definitely get a richer sense of what makes Apple tick.
Okay, let's unpack this then.
Yeah.
I mean, everyone knows Apple's sales numbers are huge. They went from about $180 billion in 2014 to, over $380 billion by 2023. Just massive.
More than doubled, yeah.
But I keep hearing the real story, the one pointing to the future, is this shift to services. Why is that so significant?
Yes, the services pivot. It's fascinating. By fiscal 23, services revenue hit over $85 billion.
$85 billion.
Exactly. And it's not just growth. It's like a fundamental change. Remember back in FY 2019, they strategically moved costs for things like Maps, Siri, even the free iCloud stuff. They moved that amortization out of products and into services.
Why would they do that?
Well, think about the margins. Services have these incredible gross margins, like over 70% recently. Compare that to products, maybe around 36%.
Wow, big difference.
Huge. So doing that boosts overall profitability.
Right.
And it clearly shows they're moving towards, more stable, high margin income. It's very deliberate.
Okay, that makes sense. A smart way to juice the numbers, or at least highlight the profitable parts. But I also heard about something subtle, a detail about their calendar. Their fiscal year ends weirdly, like late September.
Yes, the last Saturday of September.
That sounds super technical. Why does that actually matter for understanding them?
Oh, it matters quite a bit. Think about their biggest product launches, the new iPhones, right? They usually announce in September.
Right, full launch event?
Exactly. But because the fiscal year ends right then, those initial big sales numbers, they actually fall into Q1 of the next fiscal year.
So the hype hits, but the sales land in the new year.
Precisely. It kind of smooths out the end of the current year. And more importantly, it sets up that crucial first quarter, which includes the holidays, for really strong results. Blockbuster results, often.
It's like a financial timing strategy. Clever.
Very clever. It makes Q1 look amazing.
Okay, so they're smart with timing. But here's something that seems paradoxical, right? They have this mountain of cash and securities, like $148 billion in 23, just sitting there. But at the same time, they carry a lot of long-term debt, or over $100 billion going on there. Cash rich, but deep in debt.
Yeah, that definitely looks strange on the surface. But it's not distress. It's really sophisticated financial engineering. You have to remember, historically, a ton of Apple's cash was held overseas.
Right, because bringing it back meant huge taxes.
Exactly. Before the 2017 tax reforms, repatriating was very expensive. So what did Apple do? They issued debt in the U.S. pretty cheaply and used that borrowed money to fund things here, like operations, and especially their huge capital return programs.
So borrow cheap money here instead of paying big taxes on money there.
That's the logic. Optimize capital, manage the tax bill. You might even still see a line item for deemed repatriation tax payable on their balance sheet sometimes, a leftover from that change.
Okay. That makes a lot more sense than just hoarding cash while borrowing. And speaking of capital returns, you mentioned those. Apple makes so much cash from operations, often over $100 billion a year. Where does it all go?
Well, for a mature company like Apple, a huge chunk goes back to shareholders. That's a key signal. You see consistent dividend increases, right? Adjusted for splits, it went from like 11 cents in FY14 to 24 cents in FY23 per share.
Nice, steady increases.
And even more dramatically, share buybacks. Massive ones. We're talking tens of billions every year, like $77.6 billion spent just buying back their own stock in FY 2023.
$77 billion. Why do that on such a scale?
Because it directly reduces the number of shares out there. Fewer shares means the earnings per share, the EPS goes up, even if total net income doesn't jump as much. It's a direct way to boost shareholder value.
Right. Makes the remaining shares worth more, essentially.
Yeah.
Okay. And finally, let's talk resilience. We've all lived through, currency swings, supply chain chaos from the pandemic. How did Apple weather those storms? It felt like everyone was struggling.
They definitely mention those headwinds consistently in the 10Ks. Foreign exchange issues, supply constraints, logistics, it's all in there. But, and this is the key point, despite all that, Their overall sales and net income generally showed really strong growth, or if they dipped, they recovered very quickly.
They were pretty resilient then.
Remarkably so. It points to, well, several things. Intense brand loyalty, for one. Their ability to maintain premium pricing, and critically, that high-margin services business provides a real cushion. Plus, being so global helps balance out slowdowns in any one region. It's a robust model.
So pulling it all together, Apple's story over this decade isn't just about getting bigger. It's strategic shifts, clever financial plays, and just impressive resilience.
Yeah, it really highlights that shift from just a hardware company to this deeply integrated ecosystem provider.
The commitment to innovation seems clear, and definitely the focus on shareholder value too.
Absolutely. But maybe, for you listening, the thing to ponder after this deep dive is this. In a tech world that changes so fast, what does this level of financial control, this strategic integration of hardware, software, and services, what does it really mean for Apple's long-term competitive edge, especially as those lines keep blurring?
A great question to leave us with.